In just the last 45 days, the S&P 500 has wiped out a full year's worth of gains, reaching levels the last seen in April of 2024. Just last week, the Fear and Greed Index hit a record low of 3, as panic has been spreading, following Trump's tariff announcement on Liberation Day here. Since then, the stock market dropped more than 12% first, before seeing a big bounce. Bitcoin, on the other hand, only fell by 8% during that period, and has also seen a 10% move up. So while equities have been in free fall, Bitcoin's held up surprisingly well throughout this period, which is not typically what we see. In 2022, for example, stocks fell by 25%, while Bitcoin fell by 80%. With stocks down 12% in just the past few weeks before the big bounce, we should have seen Bitcoin drop a lot more than it did during the stock market decline. This kind of resilience naturally raises an important question. Is Bitcoin simply late to the party and about to catch down to the stock market? Or is this all the pain we are going to get with stocks recovering from here and Bitcoin beginning the next phase of its bull market? If we zoom out a little further, we can see this is not the first time Bitcoin has diverged away from the stock market. Like in early 2019 and from March to August of 2024, both times when Bitcoin moved sideways while stocks rallied. Or here in mid-2021, when Bitcoin sold off while the S&P continued to climb higher. In each of these cases, Bitcoin eventually did catch up with the stock market. And that's why some investors are now worried that we might see Bitcoin catch down to the S&P 500 today. If Bitcoin were to actually drop back to its April 2024 levels, that would mean a 25% decline from here, taking it back to $60,000. But for now, this is not our base case scenario today. In our view, there is a higher probability that the S&P 500 is nearing a bottom, which could also mean that Bitcoin is about to put in a bottom here, and we have a strong case to back this up. One of the clearest signals can be seen through the VIX, also known as the Fear Index. This index tracks how much volatility options traders are expecting from the stock market at any given point in time, and it tends to spike during moments of extreme panic when options traders are making bets on huge market moves in the future. In just the past month, the VIX has jumped from 17 to over 45, indicating a state of panic in the market. Now, if we draw a horizontal line at the 40 level and add the S&P 500 on top, we can see that every time the VIX crossed above this level, it coincided with some major market lows. For example, this signal coincided almost perfectly with the market low in 2020, 2015, 2011, and 2010. The only exception to this signal was 2008 during the financial crisis, when the VIX spike occurred quite close to the low. But there was one final push down before the market then reversed. In all other instances, it marked the actual low before the stock market continued higher. If that same dynamic plays out again, the S&P 500 should find a bottom relatively soon. Now, as we can see, not all of these lows saw a V-shaped recovery. In fact, except for 2020, all the others did not. Instead, the stock market continued to consolidate in the weeks following the VIX signal, before eventually resuming higher. So today, we expect a similar bottoming process, because the likelihood of a V-shaped recovery is quite low in this uncertain political environment. Now, the VIX isn't the only thing that's calling for a higher stock market. Even the macro backdrop still looks very constructive today. A big part of the recent sell-off is driven by fears that the new tariffs will raise import costs for companies, forcing them to either absorb the expense or pass it on to consumers. That could weaken demand, squeeze profit margins, and trigger a wave of layoffs. And that's exactly why recession fears are rising across the market. Goldman Sachs, for example, has now raised its 12-month recession forecast from 15% to 45% in just the past month. But there's one key indicator that hasn't confirmed that fear yet. That's the initial jobless claims. This is the number of people filing for unemployment each week. Heading into a true recession, jobless claims usually surge before and during the economic downturn, and that's when the stock market goes into a bear market decline. Right now, jobless claims are still near historically low levels. Now it could be that in the coming months, this indicator begins to rise, indicating that layoffs have actually begun. And if it does, we'll be quick to adapt our strategy accordingly. But for now, the labor market is still strong, despite Donald Trump's new tariff policies. And with countries like Japan and South Korea already in the process of negotiating trade deals, and 70 countries already in talks, it's possible that most of these tariffs will never fully take effect. so the anticipated layoffs from them are far from guaranteed. So, right now, we're looking at a market filled with extreme fear and uncertainty, but with strong economic data. We actually saw something very similar in late 2018, when the VIX also spiked sharply while jobless claims stayed near historic lows. Interestingly, this VIX spike was triggered by the same thing we're dealing with today, which is concerns around tariffs and a potential trade war with China. Back then, Trump's trade war triggered a sharp 20% drawdown in the S&P 500 during the last quarter of 2018. In fact, equities saw a vicious 15% drop in December alone. But here's where it gets interesting. Bitcoin had already completed most of its correction by the time the final stock market sell-off happened. And when stocks fell by 15%, Bitcoin held up better with just a 10% pullback, very similar to what we're seeing today. Then, as fear settled and markets realized that the macro backdrop was still constructive, both stocks and Bitcoin bottomed and began to move higher. So we think we could be in a similar setup today. If more countries finalize trade deals and Trump does not introduce new shocks, the market may be close to the process of stabilizing and forming a bottom. And if that's the case, it would be very constructive for Bitcoin, like it was back in 2018. In the short term, however, Bitcoin could remain volatile while equities search for a bottom. We could even potentially see a retest of the $70,000 support zone, which acted as the breakout region back in November of 2024. This zone also coincides with Bitcoin's uptrend line from 2023. As far as Bitcoin holds above it, we think this pullback is an attractive buying opportunity. Now, we're not expecting a parabolic move up from here, like in past cycles. Bitcoin is increasingly becoming an institutional asset, and that often brings a change in behavior and volatility. But that doesn't mean we can't still see strong moves up, like we saw in November of 2024, especially if today's panic proves to be overblown. On the other hand, if Bitcoin does break below this support zone and loses its uptrend line, that would be a warning sign in the near term. We could hypothetically see such a move if a full-blown trade war between the US and China starts to occur, and in that case, we turn more defensive in the short term. But that's not our base case right now. Looking at sentiment, macro conditions, and Bitcoin's technical structure, we think the risk-reward here still favors the upside. In March 2025, despite the very tough market conditions, we had some pretty incredible results with SLOC posting a total profit of 140% on 14 winning trades, and P-Kane securing a 50% profit across 9 successful trades. This goes to show you can remain profitable despite tough crypto conditions. You can get access to all of the trades in real time by becoming a part of our Discord community. Click the link down below to join us.